Hello, everyone. Welcome. We're just going to wait a minute or so for everyone to get into the room here. Welcome, everyone. Thank you for joining us. We're just going to wait a minute. Okay, I think we can go ahead and get started. Hello, everyone. Welcome to Year-End Tax Planning with OBBBA, what business owners and high net worth families need to know before 2026. We're happy to have you with us today. Before I introduce our speakers, a few quick housekeeping items. This webinar is being recorded, so be on the lookout for an email later today containing a link to the recording as well as the slides and other helpful content. The webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. Now, I'd like to introduce our speakers. Cheryl Orcutt is a partner in LSL's Tax and Advisory Department, where she provides a full range of tax services, including business tax preparation and year-round planning. Her goal has been to help her clients succeed, whether that means saving them money on taxes, answering business questions, advocating with the IRS or FTB, or untangling complex financial situations. She thrives on solving tough issues, tackling difficult questions, and explaining tax concepts in a way that clients can easily understand. Scott Roundtree is a senior manager in LSL's Tax Advisory Department. Scott specializes in developing smart, practical tax planning strategies for both businesses and individuals across industries like manufacturing, real estate, professional services, and agriculture. He's known for his analytical approach, creative problem solving, and commitment to serving clients with integrity. And now I'll hand it over to our speakers.
Hi, welcome everyone. We're so excited to have you here while we talk through some of the main changes that have come about in the tax law due to the OBBBA. Where we have some very interesting topics for you, some things that we've been waiting a long time to get some information on. There is a lot of information in the bill, so Scott and I picked out some of the things that we think will apply to the majority of our clients, the majority of everybody watching the webinar. Please feel free to add any additional questions in the chat, and we're really looking forward to presenting to you guys today.
Yeah, we're really excited to have everybody today. It's been a couple months since the O3BA came out, but we've been going through the process of finishing 2024. And now that that's behind us, a couple months here, we can for the next couple months we can really look at 2025. Year-end planning is always crucial, but this time of year or this year, it's very crucial because of the O3BA, a lot of changes that we want to make you aware of, and hopefully you learned something today. So let's get into it here. All right, the first topic, capital expenditures and depreciation. So we're back to 100% bonus depreciation. So one thing to keep in mind over the course of the last couple of years, what's happened when it comes to depreciation. So when the Tax Cuts and Jobs Act was enacted starting in the 2018 filing year, there was 100% bonus depreciation, but it was written in at that time. The TCJ was an 8-year period of legislation, and it was known at the time that starting in 2023, bonus depreciation was going to go down proportionately each year through until it got down to zero. So in 2023, it went down to 80%, 2024, 60%, 2025 was supposed to be 40%, then 20%, and zero. So this was a big hit for a lot of our clients, because if you have additions over 2.5 million, which is the 179 expense limitation, you were not going to be able to take full accelerated depreciation because bonus was limiting you in 2023 at 80%, last year's 2024 at 60%. So that remaining unamortized or undepreciated amount was going to be then depreciated over the remaining life of the asset, whether it was 5 years, 7 years. Well, the good news is now we're back at 100%. 100%. When is it going to expire? Well, you'll see the word permanent quite a bit here. What does permanent mean? It just means that there's no end date to when this can change. Will we have a net new tax bill in the future? Probably. Do we know when it's going to be? No. But 100% is 100% bonus is permanent until there's another legislation in the future. So it's good news for all of us that we're able to take that accelerated depreciation. But it's not that simple as saying anything added in 2025 has 100% bonus. There's a little caveat there that the date that is put into service usually is January 20th or 2025. But this year, they have different language. They talk about binding contracts. So in the past, we've always focused on the date of placed in service. So you buy an asset, what day you place it in service in your business, that's the date that we calculate the depreciation off of. But now we're talking about a binding contract. So if you have a binding contract to buy a piece of $100,000 equipment on January 10th, but you don't receive it for another month and place it in service in February, it's not eligible for the 100% bonus depreciation. So what is it eligible for? It's eligible for the 40%. So it's really something we have to pay attention to this year. Why January 20th? Well, that's when President Trump came back into office and there was a new administration. So that's the reason for that specific date. So if you had some asset additions at the beginning of the year, we have to pay special attention to that. The other part of accelerated depreciation that's still in the tax code, Section 179, that is a specific amount that we're able to take accelerated depreciation off of. There is a key difference between bonus and Section 179. Bonus is a percentage. Section 179 is an amount. So if we're able to take a specific amount off of our assets, that's going to be able to maybe get us to a bottom line number that we really want to have. So there is definitely some unique situations where we can take Section 179. So it's something to pay attention to. And I think throughout this presentation, another part of what we'll talk about is California conformity or non-conformity. So for all our clients in California, when it comes to accelerated depreciation, nothing's changed when it comes to California. California has been very stingy with that all along. They allow $25,000 of Section 179 as long as your additions are $200,000 or less. So in a lot of cases, we're not even taking any kind of accelerated depreciation. That was the case before OBBBA. That's still going into effect in 2025 and beyond. They've never conformed to any of this.
One thing that I'd like to note or kind of add to what Scott said is that for 179, they did expand it to include non-residential real estate improvements, specifically roofs, HVACs, fire security systems, things that are usually considered a component of a building that would not qualify for 179. They now do. And the reason why this is important is because if you own a building, a commercial building, you might want to look into having a cost segregation study done. The cost segregation study is going to pick and pull apart the different components of the building and allow you to take accelerated depreciation on certain parts of it. That's going to help, front load some of those expenses into the current year and not have to wait the 39 years that it takes to fully depreciate a commercial building. Another thing too that's important to kind of know the difference between bonus and 179 is Scott kind of mentioned bonus is a percentage, section 179 is a dollar amount. And the reason why that's important is because you can really use the two to kind of play around with your taxable income. In some cases, with bonus, you might not want to create an NOL, and bonus actually does allow you to create an NOL. But we'll see later on that there might be some reasons why we would not want to create an NOL. And so there would be cases where we would not take bonus depreciation, but instead we could look at taking 179 and really be able to bring that net income down to zero and kind of force what we want our ending net income to be. And that's perfectly allowable for us to do. Moving on. So I'm going to talk about the SALT deduction implications for pass-through owners. So this is actually really exciting. I know it was something that's been a really big deal for individuals over the last few years, having the state and local income tax deduction limited to $10,000. It's had a really big impact on a lot of high income earners because depending on the state that you live in, you could have very high state taxes that used to be fully deductible against your federal income, and all of a sudden we're limited down to $10,000. Because of the $10,000 limitation, we did look for a way around it. A lot of the states tried to come up with a way to allow that state tax to be deducted, and that's where the pass-through entity tax regime came in a few years ago. And if you're not familiar with that, I'll briefly kind of explain it. It's basically you calculate your state taxes at the entity level, and you are able to make a payment from your entity, and that's a federal deduction against your entity income. So you get an above the line deduction for that payment of state taxes. That payment is then a credit on your individual return, reducing the state taxes you pay on your individual return. So the reason why this is important is because there was some discussion as to if increasing the SALT limitation would get rid of the pass-through entity election. And it does not. So the PTE is still in effect. You're still able to make those PTE payments and still get the federal deduction. But for individuals who have a modified adjusted gross income of 500,000 or less, we really want to take a look and see how we can optimize both of them. For example, if you are paying your pass-through entity tax and it's completely wiping out your California income or your California income tax, you don't have $40,000 to itemize, we'll then want to look at your property taxes to see if there's maybe some property taxes we can front load into 2025 to help take advantage of that higher deduction. Or it might make sense in some cases that maybe we don't want to do the PTE through the business and just take the 40,000 as an itemized deduction on your tax return. So there's a lot of things that kind of go into it that we really want to pay attention to. I kind of briefly mentioned it, but the 40,000 does start phasing out with modified adjusted gross income of 500,000 or more for married filing joint. So there are some really good reasons as to why we would want to play around with your modified adjusted gross income, like using depreciation and some other things to try to get us into the best position to take advantage of all of these deductions.
Yeah, it really gives us a lot of flexibility this year. I think in the past, when the limitation of 10,000 was put into place, it hit everybody really hard, especially those of us in California. You own a house, you have property tax. It was a foregone conclusion. You're going to be limited, and you're not going to be able to deduct all your taxes. Well, now that's not necessarily the case. So if we're in that bucket where we're under 500,000, we have instead of 10,000 as a limitation, 40,000. So it's 400% more. There's a lot to look at there. As Cheryl said, you could front load the property tax that's due in April. If we pay that in December, we open up some deductions that we may not have had in the past. And it's really just taking a look at, hey, does pass-through entity tax still make sense? And it's a year by year analysis, because as business owners, we all know that the income changes from year to year. So it's created an opportunity for us to really dive into this a little bit more to see, okay, how can we best take advantage of this deduction? So we are still restricted, but we have more flexibility than we did the last couple of years. All right, the next topic, R&D treatment. Cheryl really wanted to talk about this one, but I'll do it. So this is a big one that hit a lot of business owners. So I think it's something that's on everybody's mind here. I think it's important to talk about first, really what has happened over the last couple of years, where we're at now, and where we're going with this. So as part of the TCGA, there was language in there that starting in 2022, the R&D expenses were no longer going to be immediately deductible. They're still deductible, but instead of being deducted as incurred, they were required to be amortized over a 5-year period. So that hit a lot of business owners pretty hard, especially 2022. That was the worst year. So you're taking let's say, for example, $1 million of R&D expenses, and you're having to amortize that over 5 years. So just like depreciation, when we amortize something, we have to have a placed in service date, and we were required to do mid-year. So you talk about July 1st is the year that you put the period of time in the year that you're putting the amortization on the depreciation schedule there. So for year one, you're really only getting a 10% benefit, because again, it's being amortized over 5 years. And in the first year, you're only being able to take half of that 20%. So, and the rest, the rest is being amortized over 4.5 years. So that really hit a lot of businesses pretty hard. And so the thinking was, since this was such a drastic change and it hit so many businesses, we thought, and a lot in the industry thought, that it was going to be reversed rather quickly, and it wasn't. And so it took 3 years for us to now get some resolution behind this. Now we're in 2025. What have they decided to do? Well, now we're going back to the old rules. We're able to take the expenses as they're incurred. So starting in 2025, we go back to the example, we have $1 million of R&D, we're able to take the full expense. And this is something that really helps with the credit side too. I know there were a lot of taxpayers out there that figured that the reversal was going to happen pretty soon. So instead of taking the amortization approach, they went and didn't take the credit. So by doing that, they were saying these expenses are not R&D. So that is no longer the case. We can take the R&D credit. So what does that mean, though, for everything that's happened between 2022 and 2024? Well, there's a couple different options here. So it's really, first, you have to look at your gross receipts or in the years that we had the R&D. If you're under $31 million, you have certain ways you can treat this. If you're over 31, you have a limited number of options, but you still have a couple options. So let's start with like the small business owners under 31 million of average gross receipts, or actually it's the gross receipts in that year. So if we're at under 31 million, we have a couple options. We can amend the prior year return. So in 2022, we're going to be able to take the 90% that's remaining. Some of it got amortized in 2023, some of it got amortized in 2024. What's remaining, we can now amend that amount and get our money back that way. We can also do the same thing for 2023, 2024. The issue, though, is what year is it best beneficial to do? Because the other option we have is we don't have to necessarily amend. We can also take the expenses the remaining expenses in 2025 and or 2026. So it's really an opportunity for us to say what is the best course of action, because as we know, over a 5-year period between 2025 and 2026, or 2022 through 2026, the everybody's tax situation is different. So we have to really analyze what's most important to our clients. Is it getting the money back faster, which we might just say, okay, let's just put all these expenses into 2025. Let's not make our estimated payments, and we'll get our money back by basically not paying. Or are we going to look back at 2022, 2023 and say, okay, we were in a high tax bracket that year. Let's amend. It's going to really help us. So every case is different. So it's going to really help us to identify which year we're going to have the highest taxes, and we can go about planning accordingly. So everybody's different. So everybody above 31 million, that option to amend the prior year returns is not applicable for you. So your options are to amortize it in 2025 or 2025 and 2026. So you do have the ability to look at those 2 years and forecast how it's going to turn out, which way is it best to approach. But we only have the ability to go forward, not back there. So another thing to think about when it comes to determining what course of action we go, we only have until July 6, 2026. So we're, 8 months away from making a determination on how we want to go about this. They give us 1 year period, because that's July 4th, I believe, was the date that the O3BA drops. So they give us 1 year to determine what we're going to do. So we've been waiting for language on how to go about doing the amendments, and we've recently gotten that. So it's a focus that we really have to take advantage of here in the next couple of months, because if we want to amortize in 2025, we want to do that analysis before it's too late. So even though we have 8 months, that's going to be here before we know it. So it's not something we can wait on. Again, the other thing too, California conformity, just so everybody knows, R&D was never required to be amortized by California. So every year back from 2022 through now, we've expensed that as they incurred, and we will continue to do that. So there's no changes for California.
All right, this is my favorite topic, high net worth moves regarding the estate tax and charitable giving. So a lot of us were waiting to figure out if the estate exemption was going to sunset at the end of 2025, if they were going to make the increase permanent or not. The good news is that they have made the increase permanent. We're now 15 million per individual, 30 million per couple. And this is going to change the way that we want to look at estate tax planning going forward. In the past, we have been very focused on reducing your estate to try to get out of that estate tax amount. Going forward, we're going to want to shift our planning into optimizing income tax outcomes and managing our asset basis. So it's probably a good idea for you to meet with your estate tax attorney and your LSL advisor. Make sure that any changes that you had made previously are looked at and adjusted so that we are taking full advantage of this new increased exemption being permanent. Also, the annual gift exclusion has increased to $19,000. This is per individual and per taxpayer. So a taxpayer can give $19,000 to 5 people, and a spouse can also give $19,000 to 5 people, and that is fully excluded, and you do not have to file a gift tax return to report that income. And when I say that's fully excluded, that's excluded from the person receiving it. They do not have to take that into income, and the person who's gifting it does not have to report it. Some really good advantages there. Another new thing, which is a really big deal, in my opinion, is that the charitable giving limits are going to be limited starting January 1st, 2026. So previously, we did have some limitations as far as adjusted gross income goes. So you were only able to deduct up to 60% of your adjusted gross income for cash donations to qualified charities, and then 30% on fair market value of assets that are given. So there were some limitations before. They've enacted now a floor, which is 2% of AGI, which makes it a little bit different. So it's an additional limitation. So we really want to look in 2025 at what we can do to kind of maximize those deductions, maybe front loading some of that into 2025 up to that AGI limit that you have, and really looking at how going forward, how are we going to take advantage of some of these options that we have to get those deductions, especially if you're very philanthropic and it's important to you to donate and to gift. This is going to help get it out of your estate as well. So there's some options that you'll want to talk with us about. One of the things that we can do is you can look at donating to a donor advised fund or a private foundation in 2025, kind of front loading some of those donations. And that gives you control where you get the deduction this year in the donor advised fund, but you don't have to donate them to charity for a couple of years. So you can kind of make some choices as far as who you want those contributions or those donations to go to. One of my favorite things to talk about is the qualified charitable distributions. So for individuals who are 70 and a half or older, you're able to contribute to a qualified charity directly from your IRA. And you can contribute, I believe it's 105,000, it might be 109,000 directly from your IRA to a qualified charity. And that is going to completely, there's no tax on that. So you do not bring it into income. It is an immediate deduction above the line. It doesn't get limited by that 2% floor. And it's a really good benefit for those who are going to have to start taking required minimum distributions. If you don't, it gives us an opportunity to kind of play with your income a little bit and kind of get that out ahead of time rather than bringing in the R&D into cash and then paying it to a charity, looking for deductions that way. An additional thing to note, I'm so sorry, I do not know what happened. An additional thing to note is that overall itemized deductions will be limited starting in 2026. This affects mostly individuals in the top tax bracket, 37%. And what it does is it essentially is limiting the benefit of those itemized deductions down to 35%. And that calculation is a little bit complicated, so we'll want to take a look if you are in the highest tax bracket and see what we can do to bring that down for you so that you can take advantage of the full itemized deductions.
You know, one thing to really keep in mind with the estate and gift tax exemption, I mean, I had written a couple blogs on our LSL website about this with the TCJA sunsetting at the end of 2025. The exemption was at an all-time high and it was set to expire and it was going to go down to TCJA amounts, and it was essentially going to be cut in half. So the thinking at the time was we have to really focus on gifting before we get to that sunsetting date, because it was known at the time if we gifted it out of our estate in that period of time, we still were able to bring that back into the estate at death with those values and at that high exemption amount. But the thinking behind the planning ahead hasn't changed, because what do we see here again? We see the word permanent. So that just means until somebody changes it. We could have a new tax code in 2029, and at that point, with TCJA bringing it to an all-time high that was doubled effectively what we had before TCJA, and it's just been inflated ever since. Where the 15 million for an individual, 30 million for married filing jointly is an all-time high. So we want to take advantage of that still while we can, because at any point in time it can go down. So the thinking behind that is still valid. We just don't have a set date right now that these all-time highs are going to expire. So really something to still consider. It wasn't all for naught. It was really just trying to understand the urgency behind it, because we have these high exemptions and we really want to take advantage of them while they're still there. So really, really good planning opportunity. I don't think there's necessarily the sense of urgency that there was maybe a year ago, but at any point we can be blindsided with a new legislation that brings us down. So it's something we definitely want to keep focused and keep moving forward with.
Another thing I wanted to add, I forgot to mention, is that the charitable giving limits, they don't apply to trusts. So that is another planning opportunity where you could look into setting up a non-grantor trust and actually having some donations go out through the trust. And it will not be limited to that 2% floor.
So I think the thing with the charitable trust really quick was that, or the charitable donation, I think it's a small amount, isn't it like 0.5%? So I think it's really, if you're very philanthropic, you're not going to see a huge impact. It's going to hit a little bit, but I still think that we should continue to go the same way we've always been in that regard, because it's not going to be this huge limit. It is there. I think it's probably part of it's a tough area for the IRS to audit. So if they limit that first 0.5%, it's not something that people can take advantage of anymore. But it is important to know if you are a standard deduction filer, that you are allowed a small amount. I think it's 1,000 per single, 2,000 for married filing jointly there. So we can still take advantage of that deduction, even if we're taking the standard deduction. Energy credits and rollbacks. So this is kind of a couple quick bullet points here. The expiring energy credits, December 31st, 2025, those are going away. So if it's something you're thinking about, putting solar panels, battery storage, things like that, that 30% credit is going away at the end of the year. So if it's something you're thinking, hey, maybe we'll do it in 2026, it's not going to have that benefit. So we have 2 months to really act with that. So it's a big opportunity to do that in this next period, the next 2 months in this period of time. So we really want to take advantage of that if we can, if it's something you're on the fence with. The other thing too, the electric vehicle credit, it's already passed, but we had a little bit of an opportunity there in the summer months to take advantage of that electronic vehicle credit. I think it's something we wanted to bring to everybody's attention, make sure that if we did have a vehicle purchased in that period of time, that you did get the credit. So big benefit for those that were able to take advantage of it at that time. So a lot of good opportunities here with the energy credits, the solar panels. We just want to make sure we take advantage of that in the next 2 months.
Take advantage of at least the solar panel ones, considering that it has to be placed in service by the end of the year. And I'm pretty sure all of the solar energy companies are really raking in the money right now.
They're getting a lot of calls, I guarantee it. So it's, they have to, it's very, it's very similar to the actual idea of the estate and gift taxing, because I had mentioned in one of the blogs, like there was going to be a time at the end of 2025 where if you needed a property appraised, well, the appraisals are going to be very busy if that high exemption is going to be sunsetting. So get out in front of it. So if you're really on the fence, you got 60 days, as Cheryl said, it's placed in service. So you want to make sure it's done in that period of time. So really something to consider right now.
I think one thing that might be a little bit easier is maybe the battery storage. So if you already have solar panels and you're on the fence of installing battery, now might be the time to actually go ahead and get that done and get that installed, and you get the 30% credit for it. Another thing that I just wanted to add, Scott, was the alternative fuel refueling the EV chargers for the EV vehicles. That credit doesn't expire until June 30th, 2026. So if you were somebody that purchased a electric vehicle before September 30th, took advantage of the credit, you can install a charger. It does apply to both residential and businesses, and you can still take that credit through June 30th, 2026. One thing to look out for. So there's so much in the bill that we were not able to spend, 3 hours talking about all of it, but some additional things that we did want to make sure that we noted for you guys is that there's an increased threshold for the 1099 miscellaneous filing. This is the filing that applies to payments made to non-corporations. Businesses are now required to file the 1099 if the payments are over 2,000 cumulative per individual, which is a good thing because it's going to reduce the amount of 1099s that your company needs to file each year, having that increased limit. Another thing to note is that the meals and entertainment expense will no longer be deductible. Previously, it was limited to 50%. This does not apply to client meals. This only applies to meals on the premise for employer convenience. So if you take your client out to eat for a business meal, you're going to want to make sure that you're categorizing that separately in your financials so that we're able to differentiate between the non-deductible expenses and the 50% eligible expenses. Also, the 80% NOL limitation is now made permanent. So that's something that did affect a lot of our taxpayers. NOLs that are generated after 2022 are limited to 80% of your taxable income. And that doesn't apply to NOLs that were generated prior to 2022. Those can still offset your 100% taxable income. But going forward, that's kind of plays back into whether or not we want to take bonus, which would generate an NOL. We need to be able to look at the NOL utilization to make sure that taking that expense and front loading it into the future makes sense. There might be reasons why we would not want to do that. Is another thing to look at. Additionally, the 199A or the qualified business income deduction of 20% is now permanent. So this is really good news for our business owners, or what we call like our pass-through owners. So a pass-through is basically if you are an S Corp or a partnership, the income flows through from the business to your personal return. And if you're a qualified business, you're able to take a 20% deduction that's now permanent going forward, which is great. We might want to revisit entity structures for those of you who are C corporations. In the past, we weren't sure if this benefit was going to stay around. And so looking at the tax rate difference on a C corp versus an individual, kind of making an educated decision on whether or not you should stay a C corp or convert to an S corp. This makes more planning available for permanent, future use. Also, qualified business stock has changed. So you qualified for a 50% exclusion if sold after 3 years, 75% exclusion if sold after 4 years, and the full exclusion if sold after 5 years. So that's some really good news. If you are interested in taking advantage of that, we can talk through that with you. And then itemized deductions changes have been made permanent. So the 750 mortgage interest limitation, the personal casualty loss limitation, and the 2% miscellaneous disallowance, those are all permanent now. Like Scott has mentioned previously, California does not conform to a lot, and California does not conform to any of these. So for California, you can still deduct the 1.1 million mortgage interest. You also have the personal casualty losses and the 2% miscellaneous disallowance as well.
And I think it's important to really look at the meals and entertainment expense, starting in 2026. So 2025, we're still under the same rules, but we're going to have to, it's going to affect the accounting because we're going to have to really be looking at it more as maybe separate categories, because we're going to have, as Cheryl alluded to, the deduction that's being disallowed going forward is the meals provided to employees for the employer's benefit. So if it's snacks in a break room, if it's lunch provided, that's the kind of thing that you have to look at. Okay, it's not deductible anymore. But there's other things that are. So if you look at events, holiday parties, things like that, those are still fully deductible. So if there's any other LSL partners on the call here, just make sure that I want to make it abundantly clear, those kind of events are still deductible. So it's not something we want to get rid of here. So it's something to really take advantage of, that we want to make sure that we have to look at these in all seriousness, the expenses. What kind of meals are we talking about? If they're taking a client out it's still under the same limitation before. It's just really that specific amount that's no longer going to be deductible starting in 2026. With the NOL limitation, a couple things here. The 80% is something that our clients experience at different times. Because if you think about prior to TCGA, there was no limitation on the NOL. There was 100%. So any NOL that was incurred before 2018 was still, it can still be utilized at 100%. So if you had an NOL from 2017, you use it in 2024, you saw that 100% reduction. So you're saying, well, what's this 80% limitation? Well, the way it works with the carry forwards is it's kind of first in, first out. So we utilize the 100% first, and then once that is depleted, we're going to be using the 80%. So if we're at a point now where 100% has all that has been used and we're going to be at 80%, you're going to see that 20% difference. So you're basically taking your taxable income, you're reducing it by 80%, but that 20% there is still going to be subject to tax. So it's something to really keep in mind. And when it comes to California too, another thing to really pay attention to for the next couple of years, California has not conformed to the 80% limitation. So they've always been at 100%. But there is something that they threw us a curveball about a year ago, where I think some of our clients experienced that this year for the years 2024 through 2026. If we have a NOL from a prior year and we have $1 million or more of taxable income, they're not going to allow the NOL to be used in those years. So if we're above that, you may have gotten surprised. If you're a C corp and you're paying 9%, I think it's a little bit lower, but you're paying 9% tax and you're at $1 million is $90,000. You're probably paying unexpectedly. So it's not going to affect anybody that has $1 million or less of taxable income. That is something to look at, because if we were at 800,000, 900,000 in 2024, what's it going to be for 2025? That's a really important thing to look at. Under $1 million, we're still going to be able to take the NOL from prior years. And if we're above that, we're not going to be able to do that. Again, this is for California only. So that was put into place for 2024 through 2026. So we're not even halfway through it yet. So the next 2 years, we got to really look at that. So again, if we have things like that, the bonuses for our great employees, if we're looking at year-end parties, might be something to look at to get those deductions below that $1 million if it's something we're looking at here. So that's something we don't want to be a surprise, because it can have a really big effect on some businesses that maybe in their first couple of years they had some NOLs and now they're really starting to make money. It's not going to be able to utilize for this 3-year period. Doesn't mean it's lost. It just means that it's not going to be able to be utilized till 2027 and going forward. So something that we really need to take a look at there. And it's going to be something that could shock people if we're not prepared for it.
Yeah, I agree. Nice plug for the party.
I'm just saying.
A
The
couple
holidays are approaching, so.
They are. A couple other things that are not on this slide, but I did want to mention, because I know they've been talked about a lot, is the no tax on tips. So workers can deduct up to $25,000 of qualified tip income from your federal taxable income. This is an above the lag deduction, and the phase out is between 150, 300,000 married filing jointly and 550 married filing jointly. So there's a big gap of income, modified adjusted gross income, where some of that might be able to be phased out for you. So pay attention. If you are somebody that earns tips, let us know. That's something that we want to make sure that we're adjusting for on your tax return. The other thing is no tax on overtime. So you can deduct up to $12,500 for single individuals, $25,000 for married filing jointly of qualified overtime compensation from your federal taxable income, Again, this is an above the line deduction, and it phases out up to 150 single, 300,000 married filing jointly. Just a couple things that you might want to pay attention to. Another thing that's been mentioned, and I've actually had a few questions on this, is the auto interest. So you might have heard that you can now deduct your interest on your auto loans up to 10,000. This is available from 2025 through 2028 only, and unfortunately, the modified adjusted gross income phase out is quite low. It's 100,000 for a single and 200,000 for married filing jointly. So it's something to look at, kind of depending on where your income is for a year. If maybe you have some NOLs to take advantage of, or you're going to have some larger deductions in one year that's going to bring your income down, we want to look at whether or not this makes sense for you as well. All right, next steps. So we really encourage all of you to meet with your LSL advisor, kind of talk through some of these things. As you can tell, there's a lot of changes that are kind of interlaced, really. They really interplay with each other a lot. The depreciation, bonus depreciation, how we can adjust your modified adjusted gross income for a lot of these limitations that we have that are coming up. Really taking a look at if we need to front load expenses into 2025 or if things can be pushed in 2026. Your LSL advisor is here to help you evaluate that and take a look. It's going to be so important this year. It's important every year, but it's so important this year in the year of a tax law change to really take a look at where you're at financially and start planning now. If we wait until filing season, February, March, it's too late to really make some changes that could seriously impact your tax. So taking a look of the last 2 months of the year, really seeing where you're going to end and making some changes and, having a plan, building out a roadmap for what the next few years are going to look like. It's a very important time to do that.
Yeah, just to kind of reiterate what you're saying here, this is our real time of year to show our value, and from an advisory standpoint. We're very limited at what we can do after the end of the year when it comes to reducing taxable income. So these next 2 months are vitally important every year. This is especially important with the OBBBA coming into effect. We're all learning a new tax code. So there's a number of opportunities that we can take advantage of, but we really need to, I know we're approaching the holidays here, but we just really need to take advantage of these 2 months and meet with your CPAs, make sure that we got a good plan for 2025 and going forward.
All right, questions. I'm going to take a few minutes and answer some questions. So if you haven't already, please go ahead and add them to the question and answer box. And Scott and I will be pulling a few. Scott, do you want to go first?
Yeah, sure. I see one here when it comes to R&D for companies with unamortized R&D costs from prior years. What factors should drive whether they take the deduction all in 2025 or spread it over 2 years? And so I imagine that comes from someone with over 31 million in gross receipts. It's really just forecasting what income looks like, because what we want to do is take the expenses in the year that's going to save the most tax. So what years are we in the highest tax bracket, and how do we get that down to the right number? So it's really going to be taking a very analytical approach and making sure that we select the right course of action. Now that's easier said than done, because one thing I didn't mention going through R&D is this is made at the entity level. And in a lot of cases, we have, obviously, partnerships have more than one owner. They could have a number of owners. We could have S corps with multiple shareholders. And the benefit is seen on the individual level, because that's reducing the taxable income that at the entity level that flows through to the individual. So it's a challenge, because we're going to have to look at this, how it affects each individual, and then come up with a plan that's best for all parties. And that may not be a simple approach. So it's going to have its challenges, but we have to really look at it because we have multiple options. And if you're below the 31 million, you have even more options because we can look back a couple years and really determine the best course of action. And the other thing too is we have to ask what's most important with our clients. Is it getting the maximum benefit back, or is it getting it back the quickest? Because if you can imagine, like a lot of people with the reduction to the R&D expenses being immediately expendable, that could have created some cash flow issues for a number of our clients. So like, are we trying to get this money back the fastest, or are we trying to reduce the overall tax liability? And it could be different for everybody.
Okay.
What we got next?
So let's see. There's a question here that says, with 100% bonus depreciation now permanent, are there still situations where Section 179 expensing makes more sense? Scott did kind of touch on this a little bit, but one thing that comes to mind when taking this, regarding this question is looking at your entity choice. So specifically for my clients that are C Corps, one of the main things we try to do is to zero out their net income. The bonus depreciation, again, is a percentage amount, and it does apply to a full amount of asset classes. So you're not able to take, let's say you put into service a $100,000 machine, you have to take bonus on the full $100,000 of that machine. But maybe you only need additional expenses of $50,000 to bring your net income down to zero. Again, we don't want to generate an NOL because we do have issues utilizing that NOL in future years, but maybe we do want to bring your net income down to zero. So we're not going to want to take bonus. We're going to want to elect out of bonus and look at taking Section 179 of just that 50,000. That's going to allow us to expense 50,000 in the current year, and the remaining value of that asset, the remaining 50,000, will be expensed over the life of the asset, usually 5 to 7 years. So there are certain situations where we do want to take a look at how bonus and Section 179 interplay and make some educated decisions on how we really want to get your net income down.
Yeah, another thing too is if we have one of those assets that was placed into or had a binding contract for January 20th, it's subject to the 40% bonus. And so we might want to take Section 179 there because it's a dollar amount. So if we're under the limitation, we may be able to fully expense it. So that's another thing that's another area we can look at this year. I do see a question in regards to that time of year. The question is, could you talk a little bit about the binding contract, especially assets bought before January 20th, 2025? Yep. So if we have a binding contract afterwards, it's not going to really matter as long as the asset is placed into service by the end of the year. It's going to be eligible for the 100%. So what do we talk about when it comes to binding contract? I think examples of that, if it's a vehicle, it's a purchase agreement. So it's you see the signature on the line that one party agrees to sell, the other party agrees to buy it. And the terms in the loan are there if that's applicable. So it's really looking at that date, because in a lot of cases when we have equipment, if we agree to buy it on January 10th, we may not get it till 30, 60 days later because it could still be under construction. So in that case, it's not going to be eligible for 100% depreciation. So prior to this, the language was really placed in service was what we were focusing on. But now we have to look at this binding contract part of it. So in a lot of cases with these major assets, big purchases, there is some kind of documentation, and if you were ever audited, that's what they'd be looking at. So that's to really make sure. I know it's looking back at a period of time that already happened, but we didn't really get this we didn't get this legislation until July. So it's really, there's nothing we can do about the date. It's more what to be aware of. And again, we can look at other options. Maybe Section 179 is the way to go with those assets. So it's really something we got to just pay attention to as we move forward.
So I see one more question here that looks really interesting. So does the limitation on deducting an NOL mean a portion of the NOL is lost permanently, or that the deduction is limited and the remainder carried forward to future years? So that's a great question.
Here's a good question. Yeah.
Yes, the NOL is not lost permanently. It's just limited and carried forward. So it can be utilized in future years, which can be a really good planning opportunity if we're looking at maybe reducing our federal tax rates in future by generating an NOL now, knowing that, we might not be able to generate NOLs later. We just have to make sure we're accounting for the fact that that 20% is going to carry forward, and a minimum of 20% of your taxable income will always be taxable, will not be able to be offset.
Yeah, I think it's probably easy to look at it with an example. If you had $100,000 loss that was incurred in 2019 and you're utilizing it for the first time in 2025 because you're in your infancy and you've had years of losses, and this is the first year you're generating income and you have losses that first, and you have $100,000 of taxable income, you're going to be utilizing 80,000 of that 100,000, and that remaining, that $20,000 that's unused from 2019 is just rolling over to 2026. So it's basically taking the taxable income for the year you're filing your return, and that taxable income is at most going to be offset by 80% by the NOL deduction. Nothing more, unless that NOL was created before 2018. So 2017 and before, those were 100%. We're utilizing that deduction, it would offset up to 100% of the taxable income. So it's really not more about the year it was generated, it's about the year it's being utilized. Hope that makes sense. If not, we need further explanation when we come in for planning. We'll talk about it some more. All right. Do we have time for any more?
Don't think so. We're almost at the end. If there's any other questions that we didn't get to, please feel free to reach out to us directly, either Scott or I or your LSL advisor. We're more than happy to talk through it. These things can be quite complicated, and again, it's based on everyone's individual situation. So we really want to take a look at where you are, what your future plans are, what your intentions and values are, and we can formulate a plan to help save you taxes going forward.
Yeah, thank you for joining us today. Let's have a really good planning season. Happy holidays to everybody. And once again, remember, those are still fully deductible. So take advantage of them. So thank you again, everybody, for meeting with us today.
Thank you, Cheryl. Thank you, Scott.
Thanks, Kimmy.